and accept that. And I'm going to put my machine in tablet mode and hold my breath as I do so. Hope that create too many problems here. Okay, I think we survived that, and we can go ahead and get started. Now, we talked about capital budgeting in another chapter, and what we're going to be talking about tonight is more the operating budget. Operating budget tends to cover a year's period of time, a 12-month period of time. And so just some terminology here. Single-use budgets are also called tactical plans. And the annual budget would be an example of a single-use tactical plan. Okay, so a single year operating budget, that's really where we're going to be focusing our attention on tonight. And then we'll get, as I said, we'll get into variance analysis later. Typically, a budget extends for 1 year. And again, when we get into discussion of capital budgeting, or as we've looked at capital budgeting, that covers more than 1 year, where we were using present value tables and whatnot to figure out whether or not we should purchase a particular investment. We use the net present value method, et cetera. All of that discussion was a capital budget. This is an operating budget, so we're not going to have to be worrying about discounting any of these cash flows or anything. And all we're saying here is that often there's a budget committee that's part of the board of directors that would be involved in preparing that budget. Now, when you look, there are different types of philosophies, if you will. There are ideal standards, currently attainable standards, and authoritative standards that can be used to prepare budgets. Okay, now for each of these, they give us advantage, disadvantage, call out. And so I would like you to go ahead and flashcard that. Ideal budgets, the benefit or the advantage is that it emphasizes continuous improvement. Okay. The disadvantage, if it's too ideal, it could demotivate employees. Currently attainable budget fosters a perception that the standards are reasonable. Disadvantage requires judgment and potential manipulation. Flashcard that, and then flashcard the authoritative standards. Advantage, it can be implemented quickly, but the disadvantage is workers may be resistant to accept those standards. Okay, so just flashcard, nothing terribly complicated about that, but make sure you have flashcarded, because again, when you get to your task-based simulation, you get to your written communication task, they really like to ask about advantage, disadvantage type questions. Okay, good. So where we're really going to begin our discussion here tonight is with the discussion of the mechanics of the master budget. Now, we always start with the sales budget. Okay, you start with the sales budget, and then you have your production budget. Okay, so you could actually number these. Then you're going to have your selling and administrative budgets, and then finally personnel budgets can come out of that as well. Now, of course, what ends up happening is we end up generating a set of budgeted financial statements, but we also end up generating a cash budget from all of this information as well. And we'll literally see how we'll be predicting what our cash balances are going to be and whatnot as we go through this process. Okay, good. Now you come over and you can see once again in a sort of a, schematic here, I guess, for lack of a better word. The first thing is the production budget. Then you have what is the sales budget. From there flows our production budget. And there we have to consider the direct materials, direct labor, our factory overhead. We come out with our selling and administrative budget, okay? And then we go ahead and we ultimately have our cash budget. But we start with the sales budget. Now, notice they're showing capital budgeting off to the side here. That's another process that would feed into the cash budget. But when you get into the capital budgeting, you're not dealing with an operating budget anymore. Now you're dealing with the time value of money and you're doing your net present value analysis, that sort of thing. Okay. Now, what's interesting about these discussion of operating budget, they kind of carve out the operating budget down here. And when you look at these questions, guys, I think a lot of times it's a little bit confusing for candidates because they're used to, we have so many rules and definitions and things that we get stuck with. And then you start looking for, well, what's the rule here? What's the definition I have to memorize? What do I have to memorize to do this? And I don't have a lot of flashcards for you in this because a lot of it is reading comprehension. You simply have to read the directions of what they're saying. They collect the first year's sales. They collect the sales 80% of the year of sale, 20% in the year after sale. Here's the information. What will they collect, say, in that second month? Well, you just have to follow the directions and apply the percentages correctly to get those kind of multiple choice questions correct. So we're going to practice with some of that, but you're going to see that I'm not going to be able to offer you as many flashcards here because it really is just reading and then following what it is that they ask you to do. So, but let's just come over. And of course, we start with the sales budget and we start to see how we will be forecasting the sales and different factors that go into that. But let's just look at this example and you're going to see that you just read the directions and see what you're supposed to do. So this Bland Ford Stereo is a retailer of audio equipment, and Blandford sales manager, I don't know if I'm saying that name right, is working with the controller to develop the sales budget for the next year. Sales manager knows that sales volume is seasonal and it can be influenced by price and promotions. The sales manager has developed the following sales forecast based on units to be sold. And then there's a smaller number of units for a higher price. And then, and I'm going to highlight here the larger number of units with the lower prices. Okay, and they do this by quarter, first quarter, second quarter, third quarter, and they're kind of taking in some seasonal considerations here. And then they do this for the fourth quarter. And again, I'm highlighting the lesser, more units, lower price, because they say that they select a cost leadership strategy, meaning that they want to go for what? More units and lower price. So if you look back, then they picked up what? They picked up all those $60 ones at the different number of units, 25, 4,000, 2,000, 10,000. And we multiply those number of units by those prices that were given, and there's our sales budget. I don't have a flashcard for you. Well, this is what you always do because you had to read and see what it was that the question was asking you to do. Now that's maybe the bad news, that you can't just memorize something. The good news is it's not that difficult for you to figure out what to do once you read through the fact pattern of the question. Okay. Okay, so we got our sales budget, and now we can go ahead and start to consider, and keep putting that graphic up there over and over again to show us the order, which we don't need to look at that every single time, because now we understand that now that we know our sales, we need our production budget. Now this I will ask you to flashcard, because you'll see questions in which they're going to ask you, what is the budgeted production? And that is going to be this sort of, I don't want to call it a formula, but way of calculating it, which is to sit there and say, well, what are my budgeted sales? What do I have to sell for the quarter, whatever the period of time they're asking me? What is my desired inventory? In other words, companies typically don't want to just sell their shelves out completely, right? So they want some stuff left in stock. So what is the desired ending inventory? So I'm going to have to sell, I'm going to have it produce enough of whatever it is I want to sell Plus, I'm going to want some stuff left over. But if I have stuff left over, then I would have started the period. Typically, it's a quarter with beginning inventory, so I don't need to produce those. So I subtract that, and that gives me my budgeted production. Okay, so you just come over and you take a look here, and they tell us that Carlisle Manufacturer is trying to estimate the level of production for the month of June. Assume that Carlisle wants safety stock, that's what's left over, the desired ending inventory, in beginning inventory of 30% of estimated sales, and that estimated sales for June and July are as follows: 40,000 for June, 30,000 for July, and we're trying to figure out June here, but notice we have to use what? The June desired beginning inventory, because we have to know that we would have had that in stock in June. So we picked that up. And then for July, they wanted what? 40% of the sales for July, or yeah, 30% of the sales for July. And so we go ahead and we want to end up with 9,000 units. So you're going to do what? You're going to sell 40,000. You need 9,000 left over, but you would have started June with the number of units that you desire to start that month with to cover that month's production, which they told us was 40,000. So you can go ahead and subtract that off. Budgeted production is 37,000. The common mistake I see is students get confused right here about this little calculation right here. They say, what am I doing? Since you would have wanted to start June with what you need for June, you have to take the June sales and multiply that by whatever the desired percentage is and subtract that, because the assumption is you would have started June with that. Question? Okay, good. Now you come over and take a look at the direct materials budget. So now, once the company knows how many units they want to produce, well, okay, that's fine. But units are not necessarily equal to the amount of materials, right? Because maybe I need 5 pounds of material for 1 unit, right? So we're going to have to convert units into the actual materials, and then we can figure out, how much material we have to buy for the period. Okay, so we can see that we're going to really look at 2 things. We're going to look at the direct materials purchase budget, but then how much of that material are we actually going to use in the period? Because again, this notion of not just being empty of shelves of units, and therefore you can't be emptying out your shelves of materials. So the amount you use and the amount you purchase will often be different. Okay, so you come over and let's go ahead and we can flashcard this. I think it's worthwhile to flashcard this, the number of direct materials to be purchased. And again, they're calling it a formula, and that might be a little, I call it more of an algorithm than a formula, but let's just take a look. Units of direct materials needed for production, add the desired ending inventory that you want at the end of the period, subtract whatever you had on hand at the beginning, and that's what you need to units of direct material that you will actually need to purchase for the period. Now, when you look here now, of course, we want to turn this into dollar amounts. So now you take a look, and the dollar amount of what's going to be purchased is the units of direct material that you just calculated to be purchased times the what? Times the dollar cost per unit. And I'm not going to have you flashcard that. I think that's pretty obvious. I'll go ahead, flashcard it. What the heck? You like making flashcards, right? Okay, so just go ahead and flashcard that too. Okay, but that's a dollar amount. Now you come over, and to figure out the actual amount of direct materials to be used, you would have your direct materials at cost plus whatever you purchased at cost minus the desired ending inventory, and that gives us the actual materials that we will use. So you're really coming up with 2 things here. What is the amount of materials to use what is the amount of materials to purchase? What is the amount that will actually be used? Some questions will say they are going to purchase and use the same amount, but that typically comes up more in our variance analysis, where they'll have the amount purchased and used, and they'll use those, and they'll say that those are the same amount. They'll say the amount purchased and used. Sometimes you'll see that, but you just got to read the question carefully, because it does depend when we get into variance analysis. If you're trying to come up with the materials quantity variance, then you have to come up with the amount used. If you're trying to use the materials price variance, then you have to use the amount purchased. So you do have to watch that a little bit in some of those questions, but many of the questions say that you purchase and use the same amount. Okay, good. Now we come up and we've got our materials. So let's look at our labor budget now. And you can flashcard this, which is the budgeted production in units, the number of hours or a fraction of hours required to produce each unit, total number of hours needed, times the hourly wage gives us our labor budget. Now, when you look at this, you got to be careful, because they say the required to produce, but you could put in here or minimum hours guaranteed. What does that mean? Well, if we promise all of our employees a 40-hour working week, and we don't need 40 hours per week to produce 40 hours times the number of employees to produce a number of units for that period, but we not going to send them home. We'll give them maybe some other tasks to do that don't directly translate into number of units, then you'd have to pick up that minimum number of hours guaranteed. So it's the larger of the actual number of hours needed to produce the number of units, or the minimum, whichever is larger. Okay. All right, good. So let's just go ahead and let's take a look at this. And again, guys, these are pretty much reading comprehension things, but we can read through these. Carlisle Manufacturing computed its budgeted production at 37,000 units to sustain budgeted sales of 40,000 units for the month of June. So they figured that they had to produce 37,000 units, right? 4 pounds of direct materials are needed to produce each unit of finished product. We assume that the new materials cost $10 per pound, and they were previously acquired for $9 per pound. Carlisle has a 48,000 pounds on hand at the beginning of June and has a desired direct materials ending inventory of 36,000. 2 hours of direct labor at $20 per hour are needed to convert the direct materials into finished goods. So what happens? We sit here and we need what? We need 148,000 pounds, because it's what? We're going to produce 37,000 units. Okay, we're going to produce 37,000 units. 4 pounds per unit, we need 148,000 pounds. Okay, now we want to have an ending inventory. They just gave us the numbers. We didn't have to calculate of 36,000, but they started the period with 48,000. So direct materials to be purchased is 136, and we're going to have to pay $10 each for those. So now we know we have to purchase. Then we're going to come out with the amount we're going to use, and notice we have to pick up those costs that were already in there at the old cost of $9 times the 48,000 pounds. So we have the $9 times the 48,000 is what we started with. We just calculated what our purchased amount was. That came down from the previous question, previous calculations, whatever. And then we subtract what we'll have an ending inventory at that $10 price that we have assigned to those materials now at the end of the period. And so the usage is 1,432,000. And then we're going to go ahead and calculate the labor, 37,000 units that we're going to produce. times 2 hours gives us 74,000 hours, times the $20 per hour gives us our direct labor budget. Question? I think you're getting the sense as to why, even though we have, a couple of flashcards up here as to how you'll calculate these things, the real, if you will, challenge is to read the question carefully, understand what the instructions are, and then simply follow those instructions. Okay, good. Factory overhead budget. Let's just take a look at that. Okay, and when we look at the factory overhead budget, we have a variable overhead rate of $5 per hour. Okay, and we want to compute the variable overhead budget. And so we're just going to go ahead, and if they have 74,000 direct labor hours, and of course they're using direct labor hours as the driver in this example, then our overhead budget is 370,000. Now you need to be careful with this a little bit, and that if there is fixed, if this includes for some reason a depreciation figure, and they're asking you what's the amount of cash that you're going to have to come out with, you would need to make an adjustment for depreciation if they were asking for the cash that is associated with the overhead. But this one didn't get into the cash discussion, nor did it talk about depreciation. But if you did, you'd have to make that adjustment. Okay, good. Then to calculate the cost of goods sold, guys, and this really, I'm going to ask you to flashcard it, but we actually flashcarded this, frankly, in previous discussions, and that it's the whatever you have budgeted as your cost of goods manufactured, that's going to come into your finished goods inventory. So you could start with the beginning plus the cost of goods manufactured minus the minus the cost of goods sold gives you the ending inventory, and then you can kind of squeeze up for your base mnemonic. So beginning, add, which is the cost of goods manufactured. The add is cost of goods manufactured. That's the amount that gets transferred out of work in process and into finished goods. Subtract what? Subtract the ending inventory, and that gives you that then gives you excuse me, subtract, not the ending. I'm looking at that thing I have your flashcard. Subtract the cost of goods sold, and that gives you the ending. Is another way to do this. And I tend to do all of my calculations of this nature just because I get into a regular pattern of doing these a certain way. And when you're taking the CPA exam, because you're not going to have a lot of time to struggle around with these questions, right? Minute and a half, 2 minutes per question, being systematic about how you go through these questions is a way to make sure that you don't run into a time crunch. Okay, good. Let's go ahead and let's take a look now at this question. And they are bringing in some additional information, but they are calling in the direct materials used, direct labor, factory overhead variable, and then that we just calculated those three, and then they start adding information here. That's why they're saying given of the fixed factory overhead, the finished goods beginning and the finished goods ending. And so notice they go ahead and they have the direct material, direct labor, the factory overhead. That's all my cost of goods manufactured, okay? And so that is the amount that was transferred into finished goods. And they're doing it the way that flashcard was showing you. Then they add the beginning finished goods inventory, goods available, minus the ending, giving the cost of goods sold. And again, you could use the base approach as well by starting with beginning inventory, adding the cost of goods manufactured, subtracting the cost of goods sold, and coming up with the ending, and then you would have to squeeze up for whatever the cost of goods sold was. Question? Okay. Okay, good. Now, when we calculate that cost of goods sold, then we would report that on our budgeted income statement. So at this point, we would be able to show our sales minus our cost of goods sold, giving us now our budgeted gross profit. And now we can move on to our operating expenses and start looking at our selling and administrative expenses. So again, here they come with that annoying, like we have to be showing that chart every single time. Okay, but notice we've got our production budget, started with sales, then production, had to come up with our three product costs, factors of production there, direct material, direct labor, factory overhead. That yield us our cost of goods sold. Now we've got our budgeted, gross profit information for our budgeted financial report. And now we can go ahead and start to look at our selling and administrative expenses. And notice, guys, that we have variable like sales commission, delivery expense, bad debt expense. Just a reminder, selling and administrative expense are what? Period costs. So they're going to all be expensed in the period incurred. And so we would be predicting, though, in this case, when we, when we're going to incur those costs, right? Or what those costs are going to be, say, in the next year or whatever. And then we'd have our sales, our advertising, our depreciation. Be careful with depreciation, guys. If they're asking you for the cash administrative budget, then you would have to back out the effects of depreciation, right? And then general and administrative, and they say they are all fixed. Okay, and now we can prepare our operating expense section of our budgeted income statement because we have that information. And we'd be done with our budgeted financial statements. Question. Now, what we would do is we would roll from here to our cash budget, and that's what we're going to look at in our next module. Okay, but let's just go ahead at this point and let's start to take a look at a couple of multiple choice questions. And so here's our first one for tonight. And I'm going to go ahead and launch the poll up for you. I'll give you a couple minutes with this one. Okay, guys, that's about 2 minutes. Looks like most of us have had a chance. Go ahead and take your best shot at that one. And okay, good. When we look at this, everybody got it right. The answer is B. The proper sequence, as we saw several times, is sale, production. Once we know we're going to produce, we know the direct materials that we need to purchase. And even though we didn't talk yet about it, you know, you can't get there with anything other than thinking that you would start with cash disbursements and see all of the choices have cash disbursements, but that's really part of what we're trying to figure out is how much cash are we going to flow to a cash budget here, and that discussion here in the next module. Question? Okay, good. Let's go ahead and let's work on the next question here. Okay, guys, I've given you about 3 minutes here because this question's a little longer. I'm going to give you 10 more seconds. Okay, I'm going to go ahead and end the poll. And pretty good. Most of us got this correct, 91% of us, so that's a good outcome. I gave you 3 minutes and 20 seconds. You probably shouldn't be spending 3 minutes with a question like this. It really should be taking you maybe 2 minutes to work something like this, 2.5 minutes. The way to increase your time once you have gotten used to the concepts and as you head into your final preparation for your exam is to be systematic. and how you go about these. Okay, so when you're first working on, it's okay if you spend 3 minutes with a question like this, but this one should be more like a 2.5 minute time use on your exam. This first one we looked at, you should be answering that in like probably 20 seconds. And so the 2 minutes that I talk about is an average, right? You don't have to stick with 2 minutes. John said I have to spend 2 minutes with every question, so I'm going to keep looking at this question one for 2 minutes. No, you can answer in 20 seconds, that's fine. Now you got a balance of time that you can use towards other questions that might be a little bit more involved. But for this question, they tell us that we have this Johnson is preparing its master budget for its first quarter of the next year. Budgeted sales and production for one of the company's products are as follows. They tell us that they have to get 4 pounds of raw material, and Johnson's policy is to have sufficient raw materials on the end of each month so that they have 40% of the following month's production requirements. And how many pounds of raw material should Johnson purchase for January? So they're asking us January, and we know that we need to look, and this is simply distractor information. That's for preparing my sales budget. They're asking me my materials budget, which means I need to look to what is it that I'm going to produce. And then I need to understand, well, how much of the material that they want to have available at the beginning of the month to calculate this. So the way I would do this, the way I like to do these is I say, well, what do they need for the month? The need for the month is at least what? At least 12,000. They know they got to have 12,000. So you're going to sell 12,000. Okay. And then they want to have what? They want to have enough left over. And if it's January, they want to have enough left over for what? February, to start February off, right? So they have these 11,000 units. I don't know why I'm writing 11,000 again when it's right there. And we sit there and we multiply that times what? 0.4. That gives me 4,400. Okay, that's the what? That's the desired ending inventory. Okay, and then they had the what? The beginning inventory. And the beginning inventory, and again, this is where I think students get hung up a little bit, is that they forget to look, well, the beginning is what I would have needed to start the month that I'm being asked for, right? Okay. And so I would have started the month of January with enough to cover January. Sometimes students say, well, I need to see December's production. No, to start the month of January, you need to look to what you wanted to have to cover January, right? So you pick up that 12,000. Again, I don't know why I'm writing it down here. All right, here times the what? 0.4 again. That means that they would have started January with 4,800 to cover themselves for January. So you, of course, subtract that 4,800. And when you do, and I know I'm probably boring you guys because you all got this one right, you get 46,400. Okay, but the most important thing I can give you as a takeaway here, although I think we did flashcard this algorithm, whatever, for calculating these kind of questions, the most important advice I can give you here is be consistent. Do these questions just like this when you're sitting there and you're doing homework, or you're doing, your practice and your final review for your exam. Be systematic the way you do these. That is going to save you lots of time so that you're not going to run into some sort of funky time crunch on your exam. Okay. Okay, good. Let's take a look at part 2. And what we're going to do now is we're going to turn these production budgets into cash budgets. Now, I don't know what they're trying to say to us with these bullets here. I'm like, I keep looking at that and I keep trying to make sense out of it. And the cash budget, okay, is whatever the beginning balance of cash is plus cash collections. And that's really going to flow from what? From our sales, right? Minus cash disbursements. Okay, minus the cash disbursements will give us our ending balance of cash. And the cash disbursements, by the way, I'm not going to write it, is going to come from our, well, I guess I could squeeze it in there. The cash disbursements will come from our what? From our production budget, which is going to be the cash we'll need for what? For our direct materials, our direct labor, and our cash part of the manufacturing overhead. And that's where that gets tricky, because manufacturing overhead has depreciation sitting in there, and depreciation doesn't use cash. So you always got to read the question carefully. If they're including as part of the overhead cost depreciation, you've got to be careful to adjust that for your cash budget. And then cash disperse, and then our admin, selling and admin. And by the way, I keep harping on the depreciation for production, but if there's depreciation on our office building, then we would need to make the adjustment for the cash budget, and that's going to yield our ending balance in cash. Okay, and if that number is negative, then we're going to have to consider some financing, or it could be positive. Let's say it's 30,000 is the ending balance, but they say, but we want to have $50,000 balance at the end of each month to start the next month. Then you have financing for that month of what? No, I forgot the numbers I said. What did I say? 30,000, and they want to have 50,000 at the end. So they'd have to borrow what? 20,000, right? To end up with a $50,000 balance. Okay. Okay, good. So let's go through each of those. The beginning, you know, they don't talk about the beginning cash balance. Okay, fine. We have a beginning cash balance, right? Okay, we don't need to read up on that. Whatever that beginning cash balance, and then we would do what? We would add the cash collections. Okay, and let's just go ahead and take a look at the next page and see how you would calculate the cash collections. Okay, again, becomes a reading comprehension thing, guys. You start to take a look at this. And they say that they are a U.S. retailer creating its cash budget based on historical data. Assume the following information: 80% of the sales will be collected in the month after the sale. So if I have a sale in January, I'm going to collect 80 a credit sale in January. I'm going to collect 80% of that in February, and then 18% in the second month after the sale. So they're telling us 18% in that example would be collected in March. Okay, 2% will not be collected. Now, sometimes students get messed up on that because they think they need to subtract that 2% that's not going to be collected. No, you just ignore that 2%. It's not going to be collected, so it's not part of the calculation, right? Okay, so then you come over and they want to figure out the cash collections in this example for September. And so we look to September and we see that what? We have September, and this is a little tricky here, guys, because they give us September cash. So we know we got to pick up September cash sales. Be careful. If they did something funky like see that on the exam, that'd be kind of mean that they put a credit, and the cash there, right? But you got September cash, so you know you got to pick that up. So we'll put that in there. And then they're telling us that what? Since it's September, we would collect what? Of the credit sales, we'd have to look at our August right here. I don't know why I highlighted September credit there, because they're not going to collect any of that in September. They'll start to collect that money in October, right? But for September, we're going to collect 80% of the previous month's sales. That's August right there. Okay, and then we'll collect 18% of July. Total cash collection. No debits, no credits, no accounting rules, no FASB said this, no, God said that, and accounting God said that. It is simply a matter of going through and following the directions. Okay. Okay, good. Cash disbursements. Okay, and when we look at cash disbursements, we're going to have our purchases for our materials, and we're going to have our payroll that we're going to have to meet. Okay, and so again, you start to take a look, and for the disbursements, you have purchases, you have to pay for your labor, and then you have your operating expenses. Okay, and again, you need to make sure to be careful with not including depreciation. So I don't know, guys. I look at this question and I just see it as a reminder of the things to consider. I mean, there's absolutely no challenge to any of this, okay? Direct materials, direct labor, overhead, okay? Gonna have to pay those, okay? Then they tell us they have operating expenses, okay? And I assume they tell us these are all disbursements. This to me would have been more interesting if they had maybe said of which 20,000 is depreciation, then I'd have to reduce that by 20,000. But okay, whatever. I'm not going to argue with the question. Capital expenditures, okay, which aren't part of our operating budget, but if we're going to acquire something in that period, then we'd have to include that. They tell us no tax payments. Okay, then why'd you bother me with it if you're not going to have a number there? And then the dividends, and we have to pick that up. Okay, sorry, there's not much more to, if you're waiting for deeper thoughts on that, stop, because there is nothing deeper that we can look at there really. Okay, good. Then we come over and we talk about financing, okay? And when we deal with the financing, we're going to see that we consider the manner and what we have to do. We have to borrow money if we have a line of credit, etc. Okay, so you take a look and let's look at this example. BECCON forecast beginning cash balance of 80,000. The company would like to ensure an ending cash balance of 50,000. In order to accomplish this, it plans to borrow 95,000 at the end of September. And then the first interest payment would not be made until October 31st at a 6% interest rate. So you just come down and you look at the cash budget here. They had what? Let's just look right here. They have a beginning balance of 80,000. They have cash collections of 1,063. So you add that. Total cash available, less cash payments, they're going to have what? They're going to have a 42,000 ending, deficit if they don't do something. So they're going to have to borrow 95,000. And at this point, there weren't any repayments, so they'll have an ending balance of 53. Now, if the question asked you, and I think this would be more, instead of asking you what the ending balance is going to be and giving you all that information, they may ask you to figure out, well, what's the amount that they need to borrow? And so if they were to sit there and ask us that, then we would know that we're having a $42,000 deficit, right? We know that we want to end up with, let's say they told you that they want to end up with 53,000. Then you know that you have to borrow 95,000. So I have seen questions that go that route. And to me, that would be more what we would be calculating in the real world even. We're saying, well, look, we know we got to spend, we're going to end up short 42,000. We need, we desire 53,000 as our ending cash balance, as our company policy, whatever. So we better borrow 95,000 to cover our deficit and still have some left over. Okay. Okay, good. Let's go ahead and note that we would make our pro forma, our budgeted financial statements, okay, from these calculations that we've been talking about. Okay, and we talked about how we would do the income statement, balance sheet would be similar. And then let's just remind ourselves that there are also capital budgets, okay? Now, this concept of flexible budget, what we've just been talking about is operating budget, there also be a capital budget. This concept of a flexible budget, and basically what we do with the flexible budget coming over is it allows us to see what the different range points would be if different factors happen. So they tell us that, hey, you have the master budget, and then you could sit there and start to calculate, well, what would happen if I was 20% over or 20% under that master budget? And then you can come up using contribution format of these different amounts that you think are going to happen. Okay, good. Let's go ahead and let's take a look at this question. I'll give you a couple minutes with this. Okay, let's go ahead and take a look at this one. We're a little over the 2-minute mark here. Most of us got this right. Whoops, sorry. The answer here is B. I didn't get a chance to, I didn't mean to clear that off that quick. I mean, the correct answer is C. I didn't mean to clear that off quite as quickly. A couple of people, I think, picked A. One person picked A, one person picked D. But let's just take a look at this question. And the basic difference between master and flexible budget is that a master budget is only used before and during the period, and a flexible budget is only used after the budget period. You know, these amounts that you're seeing, 20% one way, 20% the other way, it's still a projection. And we're just looking to see, well, what if this happens? What if this happens? This is not comparing it to like actual results. We're going to get into variance analysis later. For an entire production facility, flexible B, for an entire production facility, flexible budget is applicable to a single department only. You know, I mean, some of these I'm just like, I don't even know what to say about that choice. C, based on one specific level production and a flexible, the master budget is based on one specific level production, and a flexible budget can be prepared for any production level within a relevant range. Yeah, if our production level is less than 20% of the master or more than 20% of the master, here's the different outcomes, right? And then D, based on a fixed standard and a flexible budget allows management latitude in meeting goals. No, maybe latitude in talking about what's potentially going to happen, but it's not going to give them a pass. You know, well, gee, you know, it's okay that you use too much materials because we got a flexible budget. No. Okay. Okay, good. Let's take a look at this question. Okay, guys, I'm going to go ahead and end the poll here. We're at about 2 minutes, 30 seconds now. And most of us got this right, so that's a good outcome here. You guys are doing a good job today, but let's just go ahead and take a look. The answer is A. And I think the only thing that maybe made this question a little bit tricky was how to handle the depreciation and maybe this fixed interest expense, because in this question, they talk about a 5% inflation rate, but inflation rate is not going to affect a fixed cost like depreciation expense, and it's not going to affect a fixed interest rate, right? So we come over, and if that's the case, we take the 65,000 plus this 37,750. You know we have to pick those two numbers up, and we don't need to make any adjustment for inflation on those. And then for the other two up here, the salaries and health costs, yeah, those would be affected by the inflation. So we're going to take that and multiply, and well, we add those together. So let's just say that's 350,000. And then we're going to multiply that by 1.05, right, to ratchet it up 5% for the inflation. And I think when you do the math on that, you get 367,500. Then you just add those up, of course, and that gives you the 470,250. Okay. Question.
Good question, Professor.
Yeah, sure.
So they usually specify the budget, right? Total budget or the cash budget, because initially when I look at it, I did not include the depreciation. But then it doesn't have a selection here when I included it. It's there. So.
Yeah, I kind of led you down that path of destruction a little bit by harping again and again on the depreciation point. But yeah, I kind of thought about that when I looked at the depreciation. I heard myself talking about it. I'm thinking, I bet you somebody picked one of these other choices because they backed out depreciation. But they asked for the total budget. If they had said the cash budget, yeah, now we would ignore, not include the depreciation in the calculation. Roy?
Yes, exactly. That's what I thought. Yeah.
Okay.
Thank you.
Yep. Okay, we're going to take the break a little bit earlier than usual. We have variance analysis. I'm showing about, let's say it's 6:10 right now. So we'll come back at 6:20, okay? And we'll pick up the variance analysis. We're going to see that a lot of what the book shows us is not the way we're going to think about this stuff. I'm going to show you the way I like to set up the variance problems, and then show you how to apply that to the questions that we have in the end of B4, and then we're going to be done. So we got potential to get out kind of early today, so that's fine. Okay, all right, guys, we will go ahead and come back here in about 10 minutes. I'm going to pause the recording. Please, somebody remind me to come put it back. Oh, cool. Okay, guys, we're at the 3-minute mark. I'm going to give you 10 more seconds. Okay, I'm going to go ahead and end the poll, and 14 of us participated. I'm not sure what the other, 6 people are doing, but let's just go ahead and end the poll and take a look at this one. And good, we got a pretty good turnout here, 71%. That's good because it takes a little bit of practice to get used to these. So I'm going to go ahead and stop sharing that though. But the correct answer here is C. A couple people picked D, and I've got a way of correcting that. If you take the that result and put the C and D together, we've got pretty strong outcome here. But anyway, let's just go ahead, and the reason I'm calling out C and D here is they both have 30,000 in there, but one, this was a favorable variance. So what happens? They're asking me for the direct labor usage variance. That's the same as the efficiency variance. That means I have to take what? The standard rate, and I'm going to multiply that by the what? Standard hours minus the actual hours, right? Okay. Now, when we look at this, we pick up the information that they give us. A company produces widgets with budgeted standard materials of 2 pounds per widget at $5 per pound. We don't need that because we're looking at the efficiency variance. This is probably questions with these variance questions to look to see what variance they're asking you for. So as you're reading it, you're able to, okay, well, I don't need the number of pounds because I'm doing labor here, right? Standard direct labor was 0.5 hours per widget at $15 per hour. I look at that and I say, thank you, God. I don't argue with the question. Thank you for giving me the standard rate on labor, 15. I write that down. The actual usage in the current year is 25,000 pounds. Don't need that because we're looking at labor. And 3,000 hours to produce. Well, that's the actual hours. Thank you, God. They gave me that. To produce 10,000 widgets. Now, as I've said, and that's typically the case, it's, for the price variance, it's usually the actual hours you have to figure out. For the efficiency variance, it's usually they want you to figure out what was the standard hours. And so if I had to produce 10,000 widgets and it takes me what? It takes me a half hour, 0.5 hour per, I multiply that by 0.5, that means it should have taken me 5,000 hours by my standard, and it only took me 3,000. So that $15 times now the positive 2,000 hours is $15 times the 2,000 positive hours is where we got 30,000. And because that number is positive, it is favorable. If you always put that standard first for the materials, labor, and variable overhead variances, you won't make this mistake. Question.
I switched them. Sorry.
Yeah, no, it's okay. This is absolutely an area where you make those flashcards, you memorize those flashcards. This is has more to do with repetition. So this is more jogging than weightlifting. Okay, you just got to keep doing it and you keep pushing that, and eventually you're like, hey, I got this. And they're actually kind of fun questions. Okay, I'm going to let you do question 4. Question 3. And then we'll do question 5, and then we're going to get out.
Are you going to put a poll up?
Yeah, sorry. Yep.
Oh.
Okay, we're at about 3 minutes here. I'm going to go ahead and end the poll. So take your best shot here. So we've got 16 folks that participated. There's a couple that I think maybe have tuned out a little bit here, but that's a good result. Okay, we're seeing that we're improving on these questions. We've got 1 vote for B, which again, I think might be symptomatic of not putting the standard first in these questions. And so we really got a pretty nice, probably good 90% turnout on this question. So that's good, because that's really how it should be. And it should probably be about 2 minutes on these questions once you get more comfortable with them, even though I gave you about 3 minutes. But let's just go ahead and take a look at this one now. And this is the overhead efficiency variance. And so again, what I like to do with these when I'm looking at them is I put the, if you will, formula that I'm going to use. I like to write it down so then I can just sit there and remind myself what I'm looking for, which in this case is going to be the efficiency variance for overhead. So I got to get the standard rate. I'm going to multiply that by the standard. And here it's driver, but it actually ends up being hours, since all they give me is hours to use here. Standard hours minus the actual hours. Always put the standard first. Okay. Now I look, and now it's pick up the numbers from the question. They give me what? They give me the standard rate is $8. They tell me the standard hours are what? 12,000. They tell me the actual hours. I mean, come on. They're giving me everything, right? So that comes to what? A positive 8,000. And since it's positive, it's favorable. Okay. Okay, good. We'll come back to this question after we look at the overhead variances, but let's go ahead and let's look at this question 5, which is asking us the sales variance. Poll. Okay, guys, I'll give you 10 more seconds. Okay, let's go ahead and let's take a look at this one. And good, you guys are getting pretty good at these, although I've got a few folks wanting to pick B for some reason. But C is the correct answer. Okay, a few of us wanted to pick B. I'm not sure why, but maybe you can share with us what you were thinking. But let's go ahead and let's take a look at this. They want the selling price variance. And so again, you know, looking at our, let me stop this share here. Just looking at our you know, formula down here for our sales price, it's actual price minus standard price times the actual quantity sold. So the actual quantity sold is what? 5,000. The budgeted sales were $12 per unit, and this is the exception, guys, where I put what? For my sales variances, I put the standard, I put the actual first, then I put the standard, right? Because we want to sell for more. So it's the $12, and then $15 was the actual price. So they're selling this stuff for more. So it's 5,000 actual units sold times the $3 is where we got the 15,000. I'm not seeing the 3,750. Does somebody want to tell me what you might be looking at there?
So, somehow I thought we were answering question 4 on that one. I don't know if that,
Right,
Oh,
we did
okay.
question
No, I
4.
wanted to do 5 because we're going to come back.
Sorry.
okay, yeah, that was my confusion. I answered
Okay.
question 4 for that one.
Okay. Okay. All right, good. Well, when we get to question 4, we know who will be asking for some information on. Okay, but let's go ahead. Andrew, the reason I didn't want to do that one yet is I haven't shown you those formula because they're up here in the book and there's some commentary that is made in the book about those that I find helpful. So I figured I'd wait to show you because we did our variable overhead, but we didn't do our fixed overhead. And so for our fixed, we have a budget spending variance versus a volume variance, okay? And I want you to flashcard this, but again, flip these, put the budgeted, and I don't know why Becker does this. I don't know why they keep putting the actual before the budgeted. It's not the way to look at it. Put the budgeted first, then put the actual, okay? And then let's just take a look here. They tell us a favorable variance occurs when actual fixed overhead costs are less than budgeted and unfavorable variance results from actual fixed overhead cost exceeding the budgeted amount. And that's why I want you to flip those and put the budgeted first, okay? And then for the volume variance, again, I want you to I want you to flashcard this. I want you to flip these. I want you to put the standard fixed overhead cost allocated to production. And that's based on the actual amount of production. Put that first and then put the budgeted next. So I guess here we are kind of putting the actual applied or allocated first. So in a way we are putting the actual first versus the budgeted. And you can see down here that they tell us a favorable variance occurs when volume is higher than anticipate, which implies more units were produced using the same amount of fixed resources. Unfavorable variance is when volume is lower than anticipated. So we set up that budget expecting a certain amount of volume. And if that volume goes up, then the amount that has been applied to our jobs is going to be larger. And that's good because it looks like we must have produced more units because we're looking at the volume variance. Okay, and so flashcard that outcome along with the formula. And now let's look at question 5 or whatever it was 4. Let's do it this way. Look at here. Okay, guys, I'm gonna give you a couple more seconds here. Okay, good. The folks that are still participating, all of them got it right. Only 9 of us. There's some 8 of us not doing this question, but let's just go ahead, and maybe I didn't give you enough time, but let's just go ahead. I stopped you because I didn't want you to get tangled up in a lot of this superfluous information that's in this question, because they give us what for the volume variance, they give us what? They give us the volume, and they tell us that the what? That the overhead cost per unit is $1. That's the predetermined rate for this. So what happens? So we put the actual first. So they would have applied the overhead at $1 per unit at $19,000, and they had budgeted what? That it was going to be 20,000 because they were expecting more volume, which means that we are spreading our overhead over fewer units, or fixed overhead over fewer units. That gives me a negative 1,000. That is unfavorable because it's negative, because we were applying our overhead through over less units than what we had anticipated we would apply it. Question? Okay, guys, that's chapter 4. I'm not going to try to pile chapter 5 into your head right now. I think that's a good, efficient amount of information that's in your head. Most important thing is to practice with these variance questions along the lines of what we did, drilling using these formula, and I think you'll see that you'll get better and better at these and be in good shape for these. Okay, guys, if there's nothing else, I'm going to go ahead and stop the recording, and we will